Hello, in this presentation, we will review the key concepts from Chapter 1 by looking at some example problems. Please note that the content in this recording assumes that you have already reviewed the Chapter 1 reading materials and the Chapter 1 lecture. So let's get started. So some of the concepts that are covered in this presentation include the use of the accounting equation, computation of the return on assets, and preparation of the income statement, statement of retained earnings, balance sheet, and statement of cash flows. So in its simplest form, the accounting equation says that assets must equal liabilities plus equity. And in each of the following parts A, B, and C, we're provided two of the three numbers and asked to solve for the missing piece. So in part A, liabilities are equal to 20,000, equity is equal to 45,000, and if assets must equal the sum of liabilities and equity, then $20,000 plus $45,000 means that assets must equal $65,000. In part B, assets are $100,000, liabilities are $34,000, and we're to solve for equity. So $100,000 minus $34,000 must mean that our equity is $66,000. In part C, $154,000 of assets minus $40,000 of equity must mean that our liabilities are equal to $114,000. So this is the exact same problem with just some different numbers. So why don't you take a few minutes, pause the recording, and solve for each of these missing pieces in parts A through C, and then you can resume the recording and we can go through the answers. So hopefully you were able to solve for each of the missing pieces without a whole lot of trouble. So let's review the answers. So in part A, liabilities are $145,000, equity is $47,000, and so assets must be $192,000. In part B, assets are $120,000, liabilities are $58,000, and so $120,000 minus $58,000 must mean that equity is equal to $62,000. In part C, assets are $226,000, liabilities are unknown, and equity is $75,000. And so 75,000 plus what number gets you to $226,000? That's $151,000. Okay, so taking the accounting equation a step further, in A, B, and C, in this problem, they're asking us for a variety of different things. So let's see if we can apply this word problem using the accounting equation to solve for the answer. So in part A, at the beginning of the year, Shan Company's assets are $300,000, equity is $100,000, and then during the year, assets increased by $80,000 and liabilities increased by $50,000. And they're asking us to figure out what the equity is at the end of the year. So using the same format as we did in the last two problems, let's populate the boxes with the data that we know. So at the beginning of the year, they tell us that Shan Company's assets are $300,000. They also tell us that the equity is $100,000. So because we have two of the three numbers in the accounting equation, we can solve for the third. So if assets are 300 and liabilities plus equity have to equal 300, then if you take 300,000 less $100,000 of equity, your liabilities are 200,000. So moving on to the changes during the year. So they tell us that the changes in assets are an increase of 80,000. The changes in liabilities are an increase of 50,000. And so again, we can solve for the changes in equity because assets always have to equal liabilities plus equity. So $50,000 plus what number gets you to 80, or $80,000 less 50,000 means there's a increase in equity of $30,000 during the year. And then finally, our ending balance. So if you start with $300,000 of assets and your change is an increase of 80, then your ending balance in assets is going to be $380,000. 300 plus the increase of 80 is 380. Same thing for liabilities. 200 plus the increase of 50 means that we're ending the year at $250,000 of liabilities. And then you can solve vertically or horizontally for the ending equity, which is what the question is asking us. So if we solve vertically, 100,000 plus 30,000 gets you to 130, or 380,000 minus 250,000 is also 130. So what is our equity at the end of the year? It's 130,000. So in part B, Twitter has assets equal to $123,000 and liabilities equal to $47,000 at year end. What's the total equity for Twitter at year end? This one's a little less complex than the first one. Assets of 123, liabilities of 47,000 plus what number gets you to 123,000? That's $76,000. At the beginning of the year, Pandora's liabilities equal $70,000. During the year, assets increased by $60,000, and at year end, assets equal $190,000. Liabilities decreased by $5,000 during the year. What are the beginning and ending amounts of equity? So same as part A, if we populate the pieces of information that we know, our beginning balance in liabilities is equal to $70,000. We know that the change in our assets is $60,000. We also know that at year end, our total assets are $190,000. And then we also know that liabilities decreased by $5,000 during the year. So if we ended the year at $190,000 of assets and we had increased 60 during the year, 190 minus 60 means we've started the year at 130,000. And then they told us that we start the year with 70,000 in liabilities. During the year, liabilities decreased by 5. So that means at the end of the year, we've got liabilities equal to 65,000. Now we can solve horizontally for equity. So if you start the year at $130,000 of assets, and you start the year with $70,000 of liabilities, 70,000 plus what number equals 130? That would be $60,000. So if we solve horizontally for the change in equity, during the year, assets increased by 60. During the year, liabilities decreased by 5. So what number less 5,000 is going to equal 60? That's $65,000. And then we can solve vertically or horizontally for the ending equity. So $60,000 plus 65 increase in equity during the year means we end the year at $125,000 of equity. So the question that the problem is asking us is, what are the beginning and ending amounts of equity? Your beginning amount is $60,000 and your end amount is $125,000. Okay, so this one is very similar to the problem that we just worked through. So why don't you take a few minutes, pause the recording, work through it yourself, and then resume the recording and see how you did. Okay, so hopefully that didn't give you too much trouble and you were able to get through those questions relatively easily. So let's review. So at the beginning of the year, Shan Company's assets are $600,000, equity is $150,000. During the year, assets increased by 90, liabilities increased by 40. What's the equity at the end of the year? So let's populate the table with the data we know. So beginning assets are 600,000. Beginning equity is 150,000. And so we're solving for liabilities. So 150,000 plus what number equals 600,000? That's 450,000. And then the change during the year, assets increased by 90, liabilities increased by 40, So what did equity increase by? Well, $40,000 plus what number equals 90? That's $50,000. And then our ending balance in our asset accounts, so if we start at 600,000, we increase by 90 during the year. 600 plus 90 is 690,000. Liabilities, you start the year at 450,000. It increases by 40. So at the end of the year, we have 490,000. And if we start the year with $150,000 of equity, equity increased by 50,000 during the year. We end the year with $200,000 of equity. So the question is asking us, what's the equity at the end of the year? It's $200,000. So part B, Twitter has assets equal to $160,000 and liability equal to $40,000. So what is the total equity for Twitter at year end? Well, they tell us that assets are $160,000, that liabilities are equal to 40, and so $40,000 plus what number equals $160,000? Equity is 120. Okay. And then part C, at the beginning of the year, Pandora's liabilities equaled $100,000. During the year, assets increased by 40, and at year end, assets were equal to 230,000. They also tell us that liabilities decreased by 25,000 during the year. So what are the beginning and ending amounts of equity? Well, let's populate the table with the data we know. So beginning balance, we know that beginning balance in liabilities is $100,000. We also know that the change in our assets was an increase of $40,000. And we know that our year-end assets are equal to $230,000. So $230,000 minus the change of 40 would give us our beginning balance of 190,000. And then we can solve for equity at the beginning of the year. So if assets are equal to 190,000 and liabilities are equal to 100, then equity must be equal to 90. And then we also know that liabilities decreased by $25,000 during the year. So $100,000 minus $25,000 equals $75,000. There's our 90 that we solved for just a second ago. So if we have $40,000, a $40,000 change in our assets, and we have a $25,000 reduction in our liabilities, what number minus $25,000 is equal to 40? That'd be 65. So $65,000 change in equity minus a $25,000 reduction in liabilities equals a $40,000 change in assets. And then we can solve for our ending balance. So $230,000 ending balance in assets. We have a $75,000 ending balance in liabilities. So 75,000 plus what number equals 230,000? It's $155,000. So hopefully you got that all correct. And it didn't give you a whole lot of trouble. Okay, so let's talk about return on assets. So Swiss Group reports net income of $40,000 for the current year. At the beginning of the year, Swiss Group had $200,000 in assets, and by the end of the year, the assets had grown to $300,000. What is Swiss Group's return on assets? So the formula for calculating return on assets is net income divided by average total assets equals return on assets. So net income is $40,000, as they tell you in the first sentence of the problem. And then to compute the total average assets, you take 200,000 at the beginning of the year plus 300,000 at the end of the year, divided by 2, for an average of $250,000. So average total assets is 250. 40,000 divided by 250,000 is 16% return on assets. Return on assets is also can be called return on investment as well. All right, so now why don't you give it a shot? Pause the recording, see if you can compute the return on assets correctly for this problem, and then resume the recording and we'll go through the answer. Okay, so Swiss Group this time reports net income of $70,000 for the current year. At the beginning of the year, they had $300,000 in assets, and by the end of the year, the assets had grown to $400,000. So what is Swiss Group's return on assets? So net income divided by average total assets equals return on assets. So net income is $70,000, which they tell you. Your average total assets, $300,000 at the beginning of the year plus $400,000 at the end of the year, divided by 2 for an average total assets of $350,000. 70,000 divided by 350,000 is 20% return on assets. Okay, so hopefully that was another easy one for you. Okay, so the final concept for chapter 1 is preparing the 4 main financial statements. So the first of which we're going to look at is the income statement. So on October 1st, Ebony organized Ernst Consulting. On October 3rd, the owner contributed $84,000 in assets to launch the business. And then on the 31st, the company's records show the following items and amounts. So we want to use this information to prepare an income statement for the business. So if you remember, the income statement reports all of the revenue and all of the expenses for a period of time, in this case, the month of October. And so one of the first things that I would do when you get a problem like this is you have to sift through or filter through all of the information to determine what it is that you need and what you don't, because a lot of times you'll get extra information. So the first thing that I would do is I would go through all of the accounts and figure out what accounts are asset accounts, what accounts are liability accounts, what accounts are revenue and expense accounts, and then what accounts do we need. So in this case, we only need the revenue and expense accounts. So cash, accounts receivable, office supplies, land, office equipment, those are all asset accounts, and we don't need those for purposes of preparing an income statement. So those can go away. The accounts payable account is a liability, and we also don't need liabilities to prepare our income statement. So we can get rid of that information as well. And then common stock and cash dividends, those are equity accounts, which are also not needed to prepare the income statement. So let's get rid of those as well. So what we're left with is revenue and expense accounts, which is exactly what we need to prepare the income statement. So basically, you bring each of the account names and each of the account balances down to your statement in the appropriate section. So the first section is your revenue. So consulting revenue for $14,000. Then you want to list all of your expenses with a subtotal. So you'll have your rent expense for $3,550, salary for $7,000, telephone expense for $760, miscellaneous expenses for $580. So you have a subtotal of expenses for $11,890. And then you have to compute your net income or your net loss. In this case, we have revenue that exceeds our expenses, so we're going to have net income. So revenue of $14,000 less expenses of $11,890. So we have net income of $2,110. And that $2,110 is ultimately going to be transferred to our statement of retained earnings, which we'll do in the next section. Okay, very similar to the problem that we just went through. Here are some different numbers, but same basic problem. Why don't you take a few minutes, prepare the income statement like they ask, and then when you're finished, you can resume the recording and we can go through the answer. Okay, so again, same information, different problem. Remember, the income statement is for a period of time, and it reports all of the revenue and expenses, in this case, for the month of October. So filter through all of your accounts and figure out what accounts you need to prepare your income statement, and then you can disregard the rest of them. So again, all of those first accounts that we see, cash and office supplies and lands, we don't need any of that. Those are asset accounts. They don't belong on your income statement. Accounts payable is a liability, does not belong either. Common stock and cash dividends do not belong on your income statement, and you're left with your consulting revenues and then all of your expense accounts. All right, so did you get consulting revenues of $25,000 and then total expenses of $16,050? And then what about a net income number of $8,950? That's what your income statement should look like. Okay. Okay, so our second statement is the statement of retained earnings. So retained earnings is the accumulation of all of the profits and losses, less any dividends that have been paid to shareholders over the entire life of a business. So the same data here as we had in preparing our income statement, but this time we're filtering through and trying to figure out what accounts and what information do we need to prepare our statement of retained earnings. So our statement of retained earnings has 4 basic lines. You start with your beginning balance and retained earnings. We said it was the accumulation of profits and losses. So you need to add your net income or subtract your net loss. And then we also said that it was net of any dividends that may have been paid to any shareholders. So we need to subtract any dividends. And then we get our ending retained earnings. So in this case, our beginning retained earnings on October 1st is 0 because the business just started. And then we need to add our net income, which is what our previous statement just computed. So from our income statement, we add our net income of $2,110, which was the consulting revenues less all of the expenses that you see boxed there in yellow. And then we have to subtract our dividends. So we look for our dividend account above. We're going to subtract $2,000. We're going to get ending retained earnings of $110. And that retained earnings balance ultimately flows through to our balance sheet, which will be the next statement that we look at. Okay, so using the same information that you prepared the income statement for on your own the last time, we're going to prepare the statement of retained earnings. So take a few minutes, pause the recording, give the statement of retained earnings a shot, and then resume the recording, and we can go through the answer. Okay, so again, Ebony just started the business, so we have beginning retained earnings of 0. We're going to add net income, which came from the income statement that you prepared on your own in the previous example. So that net income, I believe, was $8,950, which is your consulting revenues less all your expenses in that box in yellow. You're going to subtract your dividends, in this case, dividends of $2,000. And so 0 plus net income of $8,950 less dividends of $2,000 gives us retained earnings of $6,950, which will flow through to the balance sheet. Okay, so now let's prepare the balance sheet. So the balance sheet is basically a financial snapshot of an organization at a point in time. So whereas the income statement and the statement of retained earnings are for a period of time, in the case of these examples, the month of October, the balance sheet is going to be as of a point in time, and in this case, it's going to be the balance sheet or the snapshot of the organization at October 31st, or the ends of that month period. So similar to the income statement, we need to filter through and figure out what accounts we want and need to prepare our balance sheet and what accounts don't matter for preparing our balance sheet. So in our box on the bottom, assets always belong on the left side of the balance sheet. Liabilities and equity belong on the right side. And then let's go through each of the accounts up above and figure out where they belong or if they belong on our balance sheet. So cash is an asset account, and so cash is going to go to the left-hand side of our balance sheet here under the assets. So we'll bring down the cash account name and then the balance of $11,360. Accounts receivable is also an asset account and belongs on the left-hand side of our balance sheet. So we'll bring down the accounts receivable, $14,000. Office supplies is an asset account, also belongs on our balance sheet. So we'll bring that one down to the left side as well. Same thing with land and office equipment. Those are both asset accounts. Then we go to accounts payable. So accounts payable is the liability account. So that's going to come down here to the right side of our balance sheet. Common stock is an equity account, so that's also going to come down to the right side, but to the bottom section. So we have common stock here of $84,000. And then the other piece of our equity is our retained earnings. So our retained earnings comes from the statement of retained earnings that we just prepared. And the statement of retained earnings, remember we had our net income, which is the sum of our revenues less all of our expenses. And then also it had our cash dividends, which was reducing our retained earnings. So all of those accounts that are boxed in yellow sum to what is our retained earnings. And if you remember from the previous example, that was $110. And so then we add up our asset side of our balance sheet for total assets of $92,610. We hope that our liabilities and our equity also equal $92,610 because our assets must equal our liabilities plus our equity or something has gone wrong. And they do. Okay, so using the same information from the previous income statement that you prepared on your own as well as the statement of retained earnings, why don't you take a few minutes, prepare the balance sheet, then resume the recording. We can go through the answers. Okay, so again, your assets belong on your left side of your balance sheet, your liabilities and your equity on the right side. You go through all of your accounts and figure out what belongs, what doesn't. So cash, accounts receivable, office supplies, land, and office equipment are all asset accounts. Accounts payable is a liability. Common stock is an equity account. And then we pull our retained earnings from the statement of retained earnings that you prepared, which is the sum of all of those accounts that are in yellow. 6,950. Add up your total assets. Add up your total liabilities and equity. And if you're in balance, you should be good to go. Okay, so the final statement is the statement of cash flows. And the thing about the statement of cash flows is it's very similar to the income statement and the statement of retained earnings in that it is for a period of time. So in this case, the month of October. There's some things that are specific to the statement of cash flows that we'll get into as we prepare it here on the next slide. But basically using the same information that they've had us use throughout the preparation of the income statement, statement of retained earnings, and the balance sheet, they're asking for us to prepare the statement of cash flows. Now, the thing about the statement of cash flows is that you only care about cash-related items. And so they provide us with some additional information here in points A through E to help us decipher what balances in the accounts above are cash-related or affect cash and which ones don't. So let's prepare the statement of cash flows. Okay, so to make our preparation easier, all of the information that was on the previous slide has been transferred to this slide so that we have it all in one place for reference in our preparation of the statement of cash flows. So the thing about the statement of cash flows is that this is probably, there are some pieces and some knowledge that's required to do this successfully that's really are concepts that we're not going to discuss until a couple of chapters in. So it's a little bit premature in some respects, which I think makes it challenging for a lot of students. However, it is on your homework. And so I want to make sure that we walk through it in such a way that you at least have the tools to be able to get through the homework successfully. And then some pieces, parts of it will make better sense the further that we get into the class. But nevertheless, it's there and I want to make sure you can get through it. So I'm going to give you all of the tools I think you need to be able to do that. And then obviously, if you have questions, please don't hesitate to reach out. So the statement of cash flows is separated into three main categories. So you've got cash flows from operating activities, cash flow from investing activities, and then cash flow from financing activities. So cash inflows are activities that increase your cash. Cash outflows are activities that decrease your cash. Anything that is provided by or used by in the normal operations of your business are operating activities. They're classified in that category. So these are things like expenses that you pay in the course of your normal business. revenue that you collect in the course of your normal business, things like that. Investing activities are typically cash inflows and outflows that relate to investments in long-lived assets. So if you invest in a building or you invest in lands or you invest in a piece of office equipment, those types of activities show up in your cash flows from investing activities. And also, if you were to ever sell any of those long-lived assets, that would fall into your investing activity category as well. And then your financing activities is anything that is debt or equity related. So if you pay dividends to your stockholders or you receive cash because you sell common stock, those, or you take out a long-term loan, those types of cash flows fall into your financing activity category. So you'll have a subtotal for each of them, either cash used by or provided by. Operating activities, cash used by or provided by. Investing activities and financing activities, same thing. Your three subtotals will then add up to a net increase or decrease in cash. That will be added to your beginning cash balance, and then that's how you arrive at the cash balance as of, in this case, October 31st. So if we assume, what we're going to assume is that all of the activity here on the left side of the screen, we're going to assume that it affects cash unless points A through E tell us differently. And so the first thing that we'll do is we'll take our cash balance. This is our cash balance as of October 31st, and we're going to put that down here at the bottom of our cash flow statement. So we know the end answer that we need to arrive at. So that's this 11,360. And then we're going to start going through all of our accounts, and we are going to place them in the appropriate categories on our statement of cash flows. So the thing about accounts receivable and accounts payable, so accounts receivable, when you make sales to customers, you can either make sales to customers primarily one of two ways. Either they'll pay you cash for it right away, or you'll put it on account, or you'll create an account receivable for that customer, meaning they owe you money sometime in the future, but they haven't yet paid you. And so the accounts receivable balance of $14,000, there's no cash activity there because it's all customers who you've sold goods to, but they haven't yet paid you. So there's nothing in that accounts receivable balance that is cash related. Let's skip down though to this consulting revenues. So the primary source of your cash is sales from an operating activity perspective. But the thing is they tell us that no cash has been collected on the $14,000 of consulting revenues because it's all sitting here in this accounts receivable. So cash received from customers would be an operating activity line item. However, the balance is zero, or the receipt of that cash is zero because they tell you that none of your customers have yet paid. So then if we start to look at all of our expense items, we're going to presume that we've paid cash for all of these items. However, we need to make sure that in the additional information down here, it doesn't tell us something different. So if we first look at the salary expense of $7,000, in point C, they're telling us that $5,250 of that $7,000 is yet to be paid. So that means we haven't put cash out for all $7,000. You still have some of it sitting in an account payable, which is basically money you owe to somebody else, but you haven't yet paid them. And so if you haven't yet paid them, you haven't yet laid out the cash. So when we're computing the cash paid to employees, we would normally say, oh yeah, that's $7,000, but they're telling us that $5,250 hasn't yet been paid. So the actual cash that's been paid is the difference between the two. So if you take $7,000 less your $5,250, you have cash paid to employees of $1,750. It's a cash outflow, so it's a negative number. So then let's look at rent. So rent is $3,550. And if we go down here to point or letter D says the company's rent, telephone, and miscellaneous expenses were all paid in cash. So cash paid for rent is going to be your $3,550. It's money going out the door, so it's a decrease in cash. Then we have telephone expenses. So telephone expenses, they also tell us in letter D that those were paid in cash. So your cash is reducing by $760 rather. Then we have miscellaneous expenses. Also, they told us those are paid in cash in letter D. And so you've got miscellaneous expenses, reducing your cash of $580. So then you have your net cash used by operating activities because it's all a negative. The subtotal is a negative $6,640. So when you have a total outflow rather than a total inflow, the line item description is used by. And if it's a positive number or an inflow, it's provided by. Okay. All right, so moving on to the investing activities. So as we look through our list of accounts here, it looks like we have land and we have office equipment. So the question is, did we pay cash for these items or did we not? If we didn't pay cash for these items, they don't belong. If we did, they do belong. So land, in letter A, land was contributed in exchange for common stock when the owner initially invested in the business. So land doesn't have a cash impact because we didn't pay cash for that. Office equipment, however, in letter B, they tell us that we paid cash for that. So your $18,000 of office equipment is a cash outflow that belongs in your investing section of your statement of cash flows. So I believe that's the only thing that we have that belongs in investing activities. So again, because it's a total cash outflow, we have net cash used by investing activities of $18,000. And so then if we go back to our accounts here, we've got common stock and dividends, which are equity related accounts. And so equity related accounts belong in our financing section of our cash flow statement. And so the common stock, we received cash when we issued this common stock. And we think we've received, if we're assuming, we assume we received $84,000 of cash in exchange for that common stock. But in letter A, they tell us that the initial investment was a combination of cash and land. So the owner gave us cash and land in exchange for common stock. Well, the land isn't a cash related item. And so the only piece we care about for purposes of the cash flow statement is this $38,000 cash that the owner gave us in exchange for common stock. And so that's a cash inflow, so it's a positive number. And then we also paid dividends. And the dividends, all of the dividends are paid. I don't see anything here that talks about any piece of it being outstanding or not yet paid. And so we're going to reduce our cash flow from financing activities by $2,000 for the dividends that we've paid. So then we have net cash provided by rather than used by because we have a net positive number of $36,000. So you have net cash used by operating activities for $6,640, net cash used by investing activities for $18,000. Then you have net cash provided by financing activities for a total increase in cash of $11,360. Now, because the company just started, our cash balance on October 1st is zero. So you would add your cash balance that you began with to that net increase. And in this case, that was zero. So then we have an ending cash balance on October 31st of $11,360. Okay, so here is an example of a statement of cash flows that's very similar to the one that we just went through. So why don't you take a few minutes, pause the recording, see if you can't get through it on your own, and then you can resume the recording and we'll go through the answers. Okay, so hopefully you were able to get through that example without too much trouble. So let's review and see how you did. So similar to the last problem, we're going to assume all of the activity here is cash related and then use points A through E to determine what is actually cash related and what isn't. So you have your three sections on your statement of cash flows. You have your cash flow from operating activities, cash flow from investing activities, and cash flow from financing. And then your cash balance at October 31st, you know you have to get to this $11,250 because that's the balance in your cash account at October 31st. Okay, so cash flow from operating activities. So cash received from customers. So if you look at your revenue account, your balance is $25,000. Your customers are eventually going to have to pay you that cash. However, the accounts receivable balance is $25,000 too. and they tell us in letter E that no cash has yet been collected on that consulting revenue. So our cash received from customers is going to be 0. Then we can look at all of our expense accounts, and we'll presume that all of these expense accounts have also been paid in cash unless we're told otherwise in letters A through E. So cash paid to employees, we have salary expense of $10,000, but they tell us that $3,800 of that has yet to be paid. So our cash paid to employees is going to be $10,000 less the $3,800 for a total cash out the door of $6,200 at October 31st. Then we have cash paid for rents. So in letter D, they tell us that rent, telephone, and miscellaneous expenses have all been paid in cash. And so our cash paid for rent is going to be equal to the balance here of $4,500. Our cash paid for telephone expenses was $850 because they tell us in point D that it's all been paid in cash as well. And then same thing for our miscellaneous expenses, $700. Point D tells us that all of these expenses have been paid in cash. So then we have a subtotal, net cash used by operating activities, because it's all cash outflows, all negative numbers. So we have $12,250, which is just the sum of all of these. Then we move on to our cash flow from investing activities. So we have 2 long-term investments on our books, land and office equipment. And the land, in letter A, they tell us was contributed in exchange for common stock. So the 2 accounts that are affected in that scenario are just land and common stock. So if the cash account isn't affected, you don't need it for your statement of cash flows. The office equipment, however, they tell us in letter B that we paid cash for that office equipment. So we're going to have cash paid for office equipment of $18,000. We have no other investing activities. So we have net cash used by investing activities of $18,000. Then moving on to our financing activities. So we have no long-term debt. There's no loan payable or anything like that. We just have common stock and dividends. And so our common stock is $71,500. However, in letter A, they tell us that only $43,500 of that was cash because the other piece was the land. So then we have cash received from the issuance of common stock of $43,500. And then we paid dividends during the month. But then there's nothing in letters A through D that tell us anything about any of those dividends yet to be paid. So we're going to assume they were all paid. And we have dividends, cash used by payment of dividends of $2,000. So then our net cash provided by, in this case, because we have a positive cash inflow of $41,500. So then if you total all of your subtotals from the various sections of the cash flow statement, you have a net increase in cash of $11,250. Our beginning cash balance was 0 because we just started the business. And so our net increase plus our beginning balance gives us an ending balance of $11,250. So that's it for all of the key concepts in Chapter 1. I'm hopeful that this presentation will be helpful as you complete the Chapter 1 homework assignments. If you have any questions or you have any trouble as you start to work through those, please don't hesitate to reach out. But otherwise, you should be prepared and ready to go. Take care.